But I want to look at the real estate market now, and there's a bit of excitement about the place because the real estate market's starting to pick up a little bit again, especially in Melbourne and Sydney. But what are some of the worrying signs about what's going on here? I'm going to find out from Mike Newman, who heads up Analogica. Analogica is your company and you're the managing director, Mike. You've been having a good look at this. Thanks for joining us. You've noticed a rising level of mortgage stress and mortgage defaults in this country, which surprises people. Low levels compared to times of high interest rates, but even with very, very low mortgage rates, we're getting increased stress. Why? Because people are falling by the wayside in an economy that's not growing strongly enough?
Well, I think that's two-pronged. You have a slow economy, or a slowing economy, and also wage growth is not keeping up with housing. So I often like to talk about Japan as a market to look at as to how their bubble collapse actually ended up being quite problematic for the entire banking sector. Now, I'm not saying Australia is anywhere near that stage at the moment, but if we look at the gross numbers, so Japan at the peak of its bubble had 2.5 trillion Aussie dollars worth of mortgage debt. We're at 1.8, and on a population of 1/5 the size of Japan, so let's put that into context. But also, there was regulations that ended up killing the Japanese banking industry as well with the bubble collapse. Of course, rising interest rates was a larger factor that we don't have here, but eventually the mortgage stress was what basically made housing prices come undone.
But should we be encouraged then that the real estate market seems to be picking up now, or is that just going to increase the amount of stress when it comes to people's finances?
Well, I think there's almost a greater fool theory of who's getting in at the top. We're already seeing the government trying to provide incentives to new home buyers to get in at the top, and I don't think that's a very prudent strategy.
Well, they're helping people get in with only 5% deposits, effectively underwriting their mortgage insurance for them. That could expose more people to medium-term risk.
Absolutely, absolutely. I think that's the problem. That if you're getting people who are new to the property game and you're getting them up towards the height. Well, let's put some context again. Japan, Tokyo Metro prices at the peak of the bubble were 15 times income. So we're in Sydney Metro, we're probably around the 13 to 14 times if you look at the numbers. So we're not too far off those levels. So if even by the RBA's own admission, we're not going to get any further wage increases at least till after 2020. If house prices keep on going up and wages are not keeping up, well, clearly, no matter how low the interest rates go, you're going to be moving towards some form of mortgage stress.
So your worry here is about the banking sector and the extent of its exposure to all this?
Well, if you look at the banking exposure, 63% of outstanding loans are towards mortgages. At the peak in Japan, they were 41. If you look at what happened when Japan's mortgages collapsed, of that 2.5 trillion, 1.1 trillion went bad. So that's 40% of the entire loan portfolio of Japanese banks went bang.
What happened in Japan? What were the consequences?
Well, clearly you've had a 2-decade-long recession. It's growing now, but I guess you could say it's been a very, very anemic growth that the Japanese have experienced over those years. And unfortunately, I don't think Australia can mimic that. We were lucky in GFC, if you recall. Back in 2009, we didn't see any of the nasties that happened to the US or Europe. Our unemployment rate never really got above 6%, so our housing market kept ticking along thanks to a very robust China. Unfortunately, if we look at today, the US is slowing, Europe is slowing, China is slowing. We don't have any of these magical sort of economies out there that could rescue us. And with a slowing economy, I think that is only going to be putting more pressure on the jobs market.
Well, one of the reasons we got through the GFC relatively unscathed was the banking sector and the way that it was supported by the government, guaranteeing deposits and the like. What are they doing? At the moment, we're looking at regulating the banking sector increasingly, aren't we? Are we putting too many encumbrances on them?
I actually think that's the case. Reagan once said, if it moves, tax it. If it keeps moving, regulate it. If it stops moving, subsidise it. I think when the special bank tax was put on 18 months ago or so, that was phase 1 done, and phase 2, the outcomes of the Hayne Banking Royal Commission we're moving into that second phase of regulation, and I think it couldn't come at a worse time because sadly a lot of voters happen to be mortgage holders. So as much as it might look good for the politicians on TV to talk about how wonderful they are to hammer down on the cigar smoking bankers, unfortunately these things are only going to raise costs to the consumer at the end. You can't escape that fact.
What needs to be done?
Well, to be honest, I think we need to punish bad behaviour, I get that, but does it need to come with all sorts of regulations whereby a bank is now on the hook for the future of its mortgage? So if you lend someone $500,000, the bank now has to work out in 5-7 years' time, is that person's employment prospects going to be the same? And that's a very hard thing to determine. And assuming that person goes into default, it then blows back on the bank in terms of having to deal with that. I just think that's, I think what we need to do is the government also needs to be saying to people, you have to take individual responsibility if you take out a loan. Why should it always fall back to the bank? Because that just creates moral hazard.
Well, this is what's creating the situation at the moment, isn't it? Because of these historically low interest rates. So you would think people would be out there and borrowing and spending and investing, but they're reluctant to. One of the reasons they're reluctant to or finding it difficult is the increasing, I suppose, diligence of the banks, right?
Well, look, I mean, there's no one saying that diligence is a bad thing. The question is, at what point does a bank have the right to assess its own risk-reward ratios here? It's certainly, I think, incumbent upon the banks to always, I mean, their whole banking ratings are predicated on their ability to assess risk. But
on the other hand, of course, this is the problem with you have these banks, the big four, too big to fail and all of that. The government has to come in and prop them up at a time like the GFC. So governments then feel it can put other obligations on them at different times.
Well, hopefully, if government policy and central bank policy is sensible along the way, then there's actually no need for that down the line. I think that is also, we have a central bank which only seems to have a hammer in its toolkit, and everything it sees looks like a nail.
So you sound pretty pessimistic about where we're heading in general economic terms.
I do, and I think that you just have to look at the numbers out there. Of course, we can paint rosy scenarios about how great the economy is. If you look at China, it's repeating a lot of the mistakes that the Japanese made in their banking system. You've got something like $350 billion worth of non-performing loans in China. There's another category called special interest loans, which is a very polite way of saying loans that are 90 days or more in arrears. That's around $500 billion. So China is slowing. We can't escape that fact. Of course, they're an important trading partner. The US is slowing, and we can blame a lot of it on US-China trade friction, but I think it's more than that. And then with Europe, it's slowing. You know, Germany has its worst industrial production for a decade, and things are getting worse. So you kind of wonder, with this whole idea of low interest rates, what we need to understand is that people don't invest, or companies don't invest because interest rates are low. They invest because they see a cycle.
Yeah, worrying. A lot of food for thought there. Thanks, Mike.